Our agenda is to approve our minutes from last month, and I'm going to call on our Vice Chairman, Paul Johnson.
Thank you, Mr. Chairman. I reviewed the minutes of the prior meeting. I find them in order. To move for approval.
Thank you.
Second.
I have a motion and a second. Any discussion? All in favor signify by saying aye. Aye. Any opposed? Motion carries. Second thing is public comments. We have none reported, so we're going to move on to our investment report.
Good evening. I'm Ted Beatty, the Rutherford County trustee. Interest rates kind of ticked up for us this last month, in the month of March. The LGIP dropped just 1 basis point, so it basically stayed level, down just a little bit. But we were able to make a couple of investments that returned over 4%, which we hadn't seen. So we took advantage of that. And looks like when we were here a month ago, we were kind of anticipating when's the drop. It may still be a drop, but it looks a little further out than it was. So it looks like interest rates may stay kind of at this level for a while as we look into the next year. So that's my report, sir.
I have a motion and a second. Any further discussion? Not. All in favor signify by saying aye. Aye. Any opposed? Motion carries. Thank you, Mr.
Thank
Beatty.
you. Have a good evening.
Next up is our fund condition report. Michael?
Good evening. So tonight, I don't have a lot to report, so that's good news. We're right where we should be. I will add, we're a slight tick below on our property tax collections, but I did talk to the trustee about that this afternoon. We've got 2 large payers that still haven't paid, so we expect those any day now. But we're right in line with where we should on revenue. One good news is our county situs sales tax collection is still holding strong, so that wasn't an anomaly. We're still at about 17% over where we were last year. So that's really good news heading into the budget. The other thing I would give on our fund condition report tonight, and it's kind of a preview for the next couple items, and 2 things to keep in mind as we go forward, and is going to be the pension rates and how much that costs us, but you're going to hear a presentation on that tonight. And another thing is health insurance rates, which we will have more information on that coming up, but those 2 things are going to be really large for the budget next year. So as we consider, but as of right now, we're right where we should be on our revenue and our expenditures. And that concludes my report.
Chairman Harris. You got a second? Okay. I have a motion and a second. Any questions? You're recognized, Commissioner.
Michael, I was looking at some stuff with bills that we're looking into, and one of the things we were talking about with lobbyists was sales tax. And sales tax for Rutherford County kind of took a hit in February. Was that correct, or they had the wrong information?
Give me 1 second, and I have a detailed chart I can pull up. We do from time to time have a refund that we have to pay, like that property or sales tax payers, businesses apply for refunds. We did have 2 refunds last month, and of course, keep in mind we're behind on collections. Like we're always 2 months behind from when you go pay your sales tax at the merchant. But give me 1 second, and I'll pull up the detailed sheet and tell you. So for the month of February, we were still 3.84% over the prior year.
What was it in January?
In January, we were 7.52% over our prior year collections.
Yes, that's where the 4% decrease from January to February.
But keep in mind, I think historically, sales tax for us has grown at a 3 to 4% rate. So I think we're good there. I think probably what you're seeing is those 2 refunds. We had 2 refunds that were right at $30,000 to $50,000 a piece. We don't pay those. The state refunds those on our behalf and tells us, and they short our next month's payment. So if you're looking at that, that's probably my guess, without me from a 50,000-foot view. That's probably the guess, if you saw a little tick down, would be those refunds that hit that month that the state pays on our behalf.
So we're on track.
Yes.
Okay, thank you.
Yeah, overall for the year, I will add, for the countywide, including all the municipalities and cities, and all the education piece, we are 6.5% over last year. So we're over where we budgeted, so that's also good news.
Any further questions for the director? Not, we've got a motion and a second. All in favor signify by saying aye. Aye. Any opposed? Motion carries. Next item is the risk management financial reports.
Good afternoon. Good afternoon, Commissioners. So in the 264 fund for the month of March, you see revenue at $2,667,548, expenditures $2,343,397, revenue less expenditures a positive $324,151. The total for the first 3 months calendar year, you have $6,766,894. Expenditures, you have $6,737,872. Revenue less expenditures, a positive $29,023. And for the 25-26 fiscal year, you have revenue at $19,048,861 compared to expenditures $22,578,792. Revenue less expenditures a negative $3,529,931. On the 266 fund, you have for the month of March for workers' comp $5,962.50, OJI $67,887.79, and the total for the month of March is $73,850.29. For the year-to-date total, workers' comp $182,879.83, OJI $720,303.81, year-to-date $903,183.64. County attorney's fee for the month of March, $25,034.93. And that concludes my report, Mr. Chairman.
Any questions for Director Elam?
Quick question.
What?
I'm just going to make a statement. Basically, the department is in great health, correct?
I wouldn't say we're in great health. I would say that the funding is there, but we're going to have to seriously look at insurance. And I'll just to kind of key in on this a little bit, and if Michael wants to chime in, to give you a little bit of a insight into, if you go back and look at the 264 fund, for the first 3 months that you see of January of 2026, and this is where you're looking at a trend, or did we hit a peak and just have a bad 2025? We see a positive number of, for the first quarter, $29,023. This same period for 2025, we saw a negative number of $783,984. So if you compare just the first quarter and trying to see what's trending, and also if you remember there was a vote put in for an increase last year, so that is in that first 3 months. That 6% increase in insurance is in those numbers for the first 3 months. If you look at that, you're seeing a $813,000 swing from 25 to the good, from the 25 to 26. The question is, you don't want to look at that and say, well, that's the trend for the entire year for that based on just 3 months. If you go back and look at, and the reason why I say that, if you go back and you look at 2025, you ended with a $5 million deficit. And we're at for the fiscal year, at about a 3.5. My point is, it's looking good the first 3 months, but I wouldn't base everything on the first 3 months. And as Michael says, we need a little bit more time. We're trying to see, did we have a spike in claims in 2025? And then we're expecting it to come back down, maybe not to where it was at 2023 levels. And to give you another situation, in 2023, we had claims over 150,000. We had about $1.5 million increase, just claims from 23 to 25. The difference in 23 to 25. High dollar claims, which we consider over 150,000. So that's just claims. I can't do anything about claims. We just have to figure out how we're going to fund it. And I think that's what we're looking at. Continue to look at the numbers and what is this trend that we're seeing to make this prediction. We have to sit here and predict. When we set rates in May or June, we have to sit here and predict what's going to happen in 2027. We're trying to say, what are our claims going to be in 2027? And there's people that haven't even been diagnosed with these issues. So we really look at the trending numbers. How do we compare on average? How do we compare to 25? How do we compare to 24? And trying to set a trend so we don't compare everything to the best 3 months of 26.
At this point right now, we're not in our straight.
We can pay our bills, but it is a trend that we're beginning to see. I would not bank setting rates on the first 3 months of 2026. I think you're going to see something more in the middle of what the fiscal year 25-26 is, to answer your question.
But, just like they were saying, figure out how high is up.
Yes. It's, I compare it to stocks. If you have any stocks, you don't know what up is and what down is, but you try to figure what's going to trend. And it's an educated guess is what it is a lot of times. We work hard. We try our best.
Commissioner Irvin, you're recognized.
Thank you. I'll just follow up on that briefly. Can you give us an update on the bids, the rates that might be coming in, and any knowledge that you might have about the state plan rates and things like that?
So we've had multiple meetings, and for those that haven't seen the purchasing meeting, we opened 27 boxes, I think. And in some of those boxes, you can have, like Cigna might bid like 6 or 7 different things just in one box. Medical, dental, vision, stop loss, pharmacy. And so, but we opened up 27 boxes. There was more than just medical, dental, and vision, and pharmacy. But we are still trying to dissect. If you looked at the Cigna bid, it was like this thick. The Blue Cross Blue Shield bid was like this thick. And we're continuing to dissect, trying to get the bids apples to apples. When you, in your bid and in your pricing, what exactly are you including? An example would be a wellness, well-being coordinator. Is that in your bid or is it not in your bid? Cigna furnishes it, but in the other bids, is that included or did you strike that out? So when we get ready to come up and lay it out to everybody, we have a good handle that it's not going to be, we're hoping that the insurance will pretty much stay the same, that we're not sacrificing a bunch of benefits, because it's like squeezing a balloon. I can get it cheaper, but then I can take away a bunch of benefits, and that's not what we're trying to do.
So when do you anticipate having all that data put together and compared and everything? I'm trying to, in a spreadsheet form or something on those lines so that we can take a look at it as soon as we can, or start digging into it just a little bit. When do you think you'll have that?
We're anticipating May, but based on the volume of information that we're getting it looks like it may be a little bit, we may have to ask for some extension. And I also don't think the state's going to have their numbers published to where we can do a comparison 2027 states rates compared to our rates. I was hoping they would have them out before now, but it looks like
Look.
they're going to delay it also, their rates.
Let me interrupt for just a second, and either you or Michael, lay out the actual flow. You've opened the bids at purchasing, and just so you know, if you had them on your desk, Commissioner Irvin, it'd stack up over your head. Oh, I said if you had those bids on your desk, it would stack up over your head or my head.
And I can
Just
agree
what
with
they're
that.
going through, but
I'm
what,
just looking for a spreadsheet or something like that that we can start digging into.
Well, that's-
Do the comparison.
that's where I'm headed with this, is I want to, first of all, it's going back to the insurance committee, and they'll do a presentation with them, and they'll make a decision, and I'm going to let y'all walk it through how it goes back to purchasing and through the commission.
Yeah, so the intent is to be able to present it. The flow has always been purchasing opens it, insurance committee makes a recommendation. We'll make a presentation, make a recommendation. It can come to budget first and then go to purchasing. It can, but on the time frame that I think we're at, I believe it's the way it is set up. It will come to insurance first, then budget, and then I think it ends up to, with recommendation, it ends up at purchasing last, if I'm not mistaken.
That is to award the carrier or our TPA and all of the products. As far as rates go, we'll have a rate recommendation as part of the budget presentation on May 7th. But that is obviously subject to change if there was something anomaly that we happened, if purchasing changed. But you should have the spreadsheets sometime around or before May 7th or something to look into. But that doesn't mean you're set to those. So there is still time to change, but we haven't seen them yet either. I think the consultant or the broker and consultant is still going through those to give us the spreadsheet so that we can start doing our analysis. Because I haven't been able to do my rate analysis yet until we get that back from our third party.
Right, I'm just trying to get as much data as we can, as soon as we can, basically, so that we can not only look at the rates, but look at all the components that go into the rates, the benefits, et cetera. And rather than try to do it all at once at last minute, et cetera, then I'm just kind of looking for a spreadsheet, more data than we get now.
But that's what I'm trying to say is when you see that initial presentation, there's going to be no rush. That you can make changes if you would like. There will not be, hey, you get it that night and you have to approve it that night. You could, because remember, these are not setting rates until January of 2027. So you will, if there is something that we don't like or want to look into more, you'll have some time, significant time. And then if you remember, we've got 4 or 5 meetings the first 2 weeks of May as well to dive into it. If you want, we can tack that onto any meeting in May.
Yeah, thank you, Mr. Chairman. One other quick question. The county attorney numbers, just to clarify something, okay, there was the salary basket, there was the general legal expenses basket, and then there was the hourly rates. The chart, the county attorney chart, this is, correct me if I'm wrong, the hourly expense rate, hourly expenses. So if I add up all the hourly expenses for 24-25, that was the total amount for hourly, and it would be plus the salary plus the general expenses. Is that correct?
No, I think it's just the litigation.
Right, that's what I'm saying. This chart is just the litigation. Is that accurate?
It is the litigation that's run through our insurance carrier.
Okay. What is there? Are there other charges?
There could be condemnations that we do as a county. There could be, I'm trying to think of the stuff that I would see, some animal pause cases. They're not very large, but that could be there. And we don't turn those over to insurance. So, but this is the amount. Are you looking at a chart from Ed's report?
Yes, sir.
Yeah.
Yeah, that's going to be the amount that was run through the insurance carrier.
So are all of these reimbursed?
No, the answer is it depends on the case and the dollar amount. It's on a case-by-case basis, depending on our deductible, or is it $500,000 on most PNC, Ed?
Per case or per? in total?
Incident?
Per incident?
Yes, it depends, you know, like if we have,
So we're picking up the expenses for most of these, it looks like.
well, no, it depends, because if you're looking at the chart, that gives you the monthly expense. So it could be that like one case, like we had that class action case that drug out years, or,
Okay. No, I see where you're going.
yeah.
So it could accumulate months and months and
yes.
et cetera. So, okay, got that. Okay. All right. So, but this is only the hourly part, some of which at least is submitted to the insurance carrier, some of which.
So it's all submitted. I will say
All submitted,
it is
yeah.
all submitted on here. Everything you see on here is going to be submitted and tracked by our insurance carrier as well. And then at the end of that, part of our policy says that we are reimbursement based from the carrier unless there's an extraordinary circumstance. And to my knowledge, in the last 4 years, we've only used that once on one case. And I believe it was that class action case with Juvenile.
Thank you, Mr. Chairman.
Commissioner Johnson.
Mr. Elam, this may police how high is up, but is the pharmaceutical end of it, is it more volatile than anything now? Is it giving you more trouble than anything?
Well, to be respectful of your time, there is a lot going on right now in the pharmaceutical world if you watch TV much. There is some to where the pharmacy benefit manager, they're trying to separate them from your pharmacies. There's some transparency that the federal government is working on. There's 3 big PBMs right now. 1 has settled with the federal government. 2 still lack settling with the federal government if they do settle. And so there is a lot of volatility on how that outcome is going to be and what they settle on, which affects their profit or losses, but it's mostly their profits. It's a very difficult time right now with PBMs.
Thank you very much. Do you have a motion to approve?
I do not. I have a motion. Do I hear a second? And a second for approval of his report. Any further discussion? All in favor signify by saying aye. Any opposed? Motion carries. Thank you.
Have a good night.
We do have a report coming up from the state, and I think you guys are ready. Before you come up, though, I'm going to ask Michael to make a quick statement and then invite you up to the podium, please.
I want to thank them coming tonight from Treasury. I believe it's Drew and James. But before they come up, I want to talk about the scale of what they're talking about tonight and how important it is that we take this seriously and ask them as many questions as you want. They do an excellent job presenting, because I've heard Drew at least present twice. So they're definitely the depository of knowledge for questions that I'll never be able to answer for you. But with that said, is the pension for budget for us is right at 11.9 million last year for the general fund. So we're not talking about an insignificant amount of money. The conversation tonight and our future decisions on pensions and what we do is very significant to the county. When I first got here, our pension rate was roughly 10%. And as you're fixing to see tonight and what they'll talk about, it's going to be 13.62 next year. And so I hope that y'all ask them any questions that you want about what our options are going forward. We're not advocating for any vote tonight or any change. I just want to emphasize the importance of it and the large dollar amount to it every year that it takes up. And so every time it goes up, it'll go up approximately for us next year, almost $2 million just to the general fund. That's a lot off the top before we consider raises or anything else. And so that's why I reached out to Drew and his team, and thankfully they came down. But I just wanted y'all to know the scale of what we were talking about before they come up.
Drew, please come on. Welcome.
Thank you. Appreciate y'all having me. Good evening, everyone. I'm Drew Freeman. I'm the Senior Director of Financial Empowerment with the Treasury Department. I've actually been in this room, this is the 3rd time in the last 6 weeks. I was here for some of the financial literacy discussions you all had before you all voted on that. And so this is the first time I've actually spoken in here, but it's really good to see you all. Michael had reached out and asked me to come and just go over some basic things and then talk about some options. So right off the top, I'm not here to talk you all into anything. I'm not here to talk you out of anything. I get paid exactly the same either way. But what I want to make sure you all do is have access to information. and that y'all can ask all the questions that you want and think through kind of long-term what you want out of the retirement plan for the county. And so what I'm going to do is I'm going to walk through. You all have 2 rate sheets that James handed out, I think, when we first got in here. I know this looks like a lot of numbers, and there's a lot of stuff on here, but I want to kind of walk through them. And the backdrop of this is a pension plan and a defined benefit plan, which is what we operate at TCRS, is basically a set formula which has 2 things that impact what the amount will be to the retiree. How long did you work in the system, and what was your salary in the system? So service years and salary are the drivers of the benefit. And then we are guaranteeing that benefit to the employees when they begin working here. So we have to predict a future point in time, and what we try to do is know as they're working, as they're getting raises, as they're accruing credit, we want to be anticipating that so that when they go to retire, that benefit they've been promised is there for them. Okay, because we've been funding it and pre-funding it along the way. So what you're looking at is kind of how we do that at each employer that participates in TCRS. Okay, so what I'm gonna do is I'm gonna walk through this, and I'll point out a few things as we go, and y'all stop me at any point and ask any questions you have, okay? So you have 2 rate sheets. The first one is the current year that we're in, and you'll know that by the applicable period for this employer rate, July 1 of 2025 to June 30 of 2026. Okay, then the second one, which we'll talk about in a second, July 1 of 2026, which is what Michael mentioned about the future rate, to June 30th of 2027, all right? So we're looking at the 2 fiscal years. So we'll start out looking at the one that is for 25 through 26. All those codes at the top in bold, those are the employer codes that are all tied to this actuarial pool. So that's your general county employees, your highway department, your sheriff's department. I believe y'all have a solid waste. And it also includes your community care center and also the Board of Education employees that are not teachers. Oh, yes. Apologize. I actually have 2 copies up here. I'm not sure why I have 2 of each. Okay, so do you need one as well? Okay.
Chairman Phillips, did you get?
Yo, am I good? Okay, all right. So all those codes across the top are all the employers that are tied to this specific employer's participation in the system. They're all tied to the same actuarial pool, okay? So any decision you all make or could make to change the plan or modify the plan or anything like that is going to affect all those groups. It's not just the general county employees, it's all those other groups as well, okay? Then we have the period that the rate is good for. When we pulled our actuarial valuation data, we pull the data every year on June the 30th. We basically take a snapshot of these codes and how many employees there are in them, how much they're working, what their salaries are, how long they have service in the system. We're taking that snapshot at that point. And then we have what we call our actuarial experience study, which is where we look back at the population and review things like, how did the investment markets do that period? How long did people live during that period that were members of the plan? What were salary increases during that period? All those different things, you know, listen, how long do we pay out retirement benefits to retirees? So we're trying to pre-fund in order to have the money set aside so when someone goes to retire, the money is there. All right, so we look back every 4 years and then project forward. One of those things is the investment rate of return assumption, which is the 6.75% number there. So for every dollar y'all pay into the plan, we're assuming we're going to gain 6.75% year on year in the market on average over any 10-year period. So we know sometimes the market's better than that, sometimes the market's worse than that, but any 10-year period where we can hit that number or better, we're in good shape, okay? The next section is the key elements there. The base plan formula, so y'all have a 1.5% formula. So that is the multiplier in the plan. So basically what you can do is go, what's a retiree's benefit going to be? For every year that they work in the system, it's going to replace about 1.5% of their pre-retirement income, okay? So if they work 30 years for you, 30 times 1.5, it's going to replace about 45% of their pre-retirement income. Okay? And that's how it will be. If 5 years, 10 years, so 10 years is going to replace about 15%, 20 years is going to replace close to 30%. Y'all see how that works, right? It's just a percentage of income replacement, and y'all have a 1.5% multiplier. The next piece there is the employee contribution rate, 0%. Y'all are a non-contributory plan, meaning that the employer funds the entire benefit in its entirety. The employees do not pay anything from their salary into the plan. They vest within 5 years, which is the next section, and then the cost of living adjustments y'all allow. Then you see the employer contribution rate on the left there. So if you're looking at the one for this current fiscal year, that's 12.35%. If you want to go ahead and compare it to the next year's rate that's been proposed by our actuary that y'all will vote on at some point, you're seeing the 13.62%. So over a percentage increase in the employer contribution rate, and keep in mind the employees do not pay into the plan. Okay? So when you shift over and look at the right-hand side of the page, we have the actuarial value of assets in the plan right now. Then you can see, again, expected employee contributions is 0. Then what we assume we're going to bring in that period, and then the unfunded accrued liability, which we'll talk about here in just a second. Then the next section is going to break down a snapshot on June 30th of the year we pulled it of your employee population. So the first number there is going to be the number of people we are paying benefits to who retired with service tied to Rutherford County, one of these codes at the top. All right? Could be beneficiaries, but retirees. The next section is your inactives. Those are the people who have worked here at some point, have service with the county, but have left, and they're not retired yet, but they may be retiring one day. And then the third group is your active employee population. Again, all those codes being combined. So y'all hover right around 3,200, 3,300 total employees. Then you can also see the annualized retirement benefits if you compare the two pages. So if y'all notice, between last year and this upcoming year, you went up by $1.3 million in retirement benefit payments that are going out in 1 year. And then if you notice the active employee list, notice that your active employee salary went up from $149 million up to $165 million, roughly. Okay, so salary increases, we're paying out more benefits when you compare year on year. The bottom section is our process for essentially how we amortize any liability that's not yet been funded. We basically set it up in a tier, and you all pay it off through your employer contribution rate over periods of time, not to exceed 20 years. So anytime you see a bracket in there, that means you have an asset, which is working against the liability of the plan. And anytime you don't see a bracket in those tiers, that is a debt. That is a liability that we will phase into your rate, and y'all pay it off over time. So when you total all those up, just in the last year, we went from $32.8 million in unfunded liability to now a total of $41.6 million in unfunded liability for the total plan pool. Okay? I'll stop there for a second, and if y'all have any questions. I know I thought a lot of actuarial and detailed stuff about how we calculate all this up.
Well, I'll have a quick question for you. The rate that y'all have come up with, I know in the past there are times that it is lowered.
Yes.
And one thing we did as a commission is we kept the rate, we kept paying in the same rate even though y'all had lowered. Is there a chance this might happen again as far as y'all lowering the rates, or?
It could. It could. The one thing, though, that when you look at this, what's kind of pushing against our ability to lower the rate is, you notice we still have roughly $41.6 million in unfunded liability, which we will pay off over time. You also have an increase in retiree benefits going out, and you also have an increase in salaries for the population of active employees. So again, salary drives the benefit. So the higher your salary, the more the benefit will be, and people are also accruing more service. So there's upward pressure, and because there isn't any employee contributions coming in, if there is upward pressure and we don't have any tools to kind of keep that rate flat or lower it, and the pressure pushes it upward. So to answer your question, could the rate go down? Yeah, if that $41.6 million number wasn't sitting on the bottom of that page as an unfunded liability. So options are, some employers choose to pay this down more aggressively, more proactively. Y'all could do that. Obviously, that's a big chunk of change. But that's really, or the market just does so much better than we assume it's going to, that we can take those growth numbers from the market growth to then drive down the employer unfunded liability number.
I want to add one thing to what Drew said. He talked a lot about, one of the things he mentioned was your annualized salary and how that's gone up. This current year we're under was 149 million, and next year it's 165. But if you remember back in, I believe it was 2023 budget year, it was the year before I got here, we gave 15 and 20% raises that year. When those raise, and then we've given significant raises every year, which is a great thing for our employees. But when you give raises that fast, if you look, that's right around the time on the sheet that we flipped, and now have a negative, or now we have an unfunded liability, and so it's not exactly coincided with that. But when we jumped right there to 21 million on the sheet, anytime we have that big a jump, when we had that much inflation, it's going to affect this rate. And so that's one of the reasons we're usually able to absorb this, and they've been a little higher, and they're getting harder to absorb. So that's kind of what spurred all of this conversation for me to call Drew, was starting back 2 or 3 years ago as we've been watching this. But if you remember, that's one of the things that sparked this was that, I believe it was the 23 budget year that we did that 15 and 20% raises.
And that's not a bad thing to give raises. But what we're seeing is so we're assuming y'all are going to do the cost of living, right? We're assuming a 2 to 4% roughly. So when there's a 15% raise that comes in, now we have to make sure we're getting ahead of that liability that we know we're going to have to fund, because now these employees are going to be getting a benefit based upon a higher salary that jumped quicker than we expected it to. So this is where TCRS is really well managed. We try to get ahead of things so that when that person goes to retire, the money that they were promised is there, rather than kick the can down the road. But what it does is it does have upward pressure on rates when there's salary jumps like that.
Quick question, or just a clarification. If this is we call it a legacy plan?
Yes.
Okay. So if a change were to be made, just want to be sure at the very beginning, so we don't start getting out to calls, or at least, okay, everyone who's retired or a current employee would stay on the legacy plan.
That's correct.
So there's no way to bump anybody off of it.
No.
And that's probably state law, I'm guessing.
There's legal court precedent for not taking a benefit away that's been promised to an employee in this type of program.
Okay, so it's not going to change for anybody that's a retiree or currently
That's
employed.
correct.
Okay.
This also, for clarity, so I don't get phone calls, does not include teachers.
Yes.
They are in a separate pension plan altogether from this.
That's right. Teachers are a different world. All the codes at the top are who we're talking about, which is everybody who's tied into Rutherford County who is not a teacher. Yeah.
Commissioner Gibbs.
It's a question, so just so I understand, the way I'm reading this is that there's 1,676 individuals who are receiving retirement benefits currently.
Tied to one of those, they worked at one of those codes at the top of the page. Yes.
And so that's really the number of people we're paying benefits on right now.
Yeah.
But if the 2950 and 3376, if they were all to retire tomorrow, is it correct to say that we have to have money in the bank that would take care of those?
No, so you're funding the plan through the rate. So where you see that total ADC rate there in the middle of the page, that's what y'all budget. We're phasing it in. So if all those people retired all at once, we're not asking you for a payment right then. We'll blend it into the rate, but what it will likely do is create upward pressure on the rate in future years, because we got to catch up for the number of people their retirement behavior took off. Now, not all of those inactives have all of their service here. Some of them may have worked for another county or for the state or as a teacher. And what we do is we actually source the liability back to the employer in which that service was earned. So you could work for 4 different employers in the system, and we're going to tie your service back to that employer, and it's going to show up on their rate.
But if a large number were to come up for whatever reason and retired before our rate caught up, we have plenty of money to take care of.
Yeah. The money, the actuarial value of assets, they're middle of the page, right-hand side, under the actuarial present value of benefits, PVB summary. Mm-hmm. That's the amount of money that we have sitting invested with the pension fund at TCRS, tied to these employees.
And it's average making almost 7%.
6.75 is the assumption. But yeah, the dollars are sitting there, and if you can tell, it jumped quite a bit between the last rate cycle and this rate cycle, several million. So yeah, those are dollars we have sitting tied to these employees.
So what does your actual actuarial analysis tell you in terms of the last year's rate, 12.35, 13.62? We're likely increasing based on demographics, at least, folks getting a little bit older, population shifts, et cetera. What does that look like for rates going
forward?
Forward, basically. Yeah.
So we'll pull the snapshot of data on June the 30th of 2026, here in a couple months, and then we will work this same process. So when you're working with a pension plan where you're guaranteeing a benefit based on a formula, you're always kind of shooting at a moving target. And so we just have to pull the snapshot on that date and calculate whatever that rate needs to be based upon that population at that point, salary, service, expected benefits, how much the market has provided us in growth, and then we just adjust again the very next year. So I don't try to do the prediction of, it's always going up, it's always going to go up. I mean, I'm going to go there just because it'll help you understand. You could have a bunch of these retirees who are drawing benefits all pass away in the next year. Well, those are people we no longer owe benefits to, okay? And so that would actually create, it's going to sound awful, but an asset to the plan, because we no longer have a liability that we have to pay out retirees, okay? Now, if everyone keeps living and everyone keeps accruing additional salary and service that's working here, then there is pressure to go up on the rate. But you also could have people who fall off the payroll.
That's part of a sensitivity analysis of some sort, I guess, that you ultimately do.
Yeah.
Kind of the different.
Well, we make assumptions about investment return, how long people will live, what their salary increases are likely to be, when they retire, when they decease, when they go on disability, how quickly they turn over. Do we provide a cost of living adjustment to retirees? And if so, how much is it going to be that particular year? Because inflation's been high lately, it's been at the top of our scale, which we have a cap of 3%. But inflation has been above that more recently. And so we've had to pay the full 3%, but we've been assuming we were going to pay like 2.25%. Well, that creates that upward lift and upward pressure on the rates too, because those were dollars we hadn't funded for because we had assumed that the COLA was going to be less. So again, we're always looking at all those data points and shooting at a moment in time, generating the rate, then we do the year, and then we repeat the process. And that's how we keep managing the liabilities long term.
Commissioner, we'll come back to you in a moment. The mayor's asked to be recognized, and let me recognize him first, and we'll come back to you, sure. Commissioner. Please. Oh, okay.
Thank you, Commissioner. Thank you very much.
Sure.
So I want to go to the total employer ADC rate. Give us the definition of ADC for the people at home, please.
Sure. Yeah, that's the actuarially determined contribution rate.
Okay, and can you, on that 12.35 for the current fiscal year and the fiscal year coming up at 3.62, how is that number derived, and can we always expect that number as a percentage to increase? Because as the population ages, we will potentially have many more retirees who will be accessing the retiree plan. But as you said just a second ago, those same retirees, unfortunately, will no longer receive a benefit when they expire, when they die, right?
Yeah.
So
yeah.
I'm certain you guys see that in your crystal ball. Can you kind of give us some guidance, the Budget Committee and the Mayor's Office, as to what we can look forward to 3, 5, and 10 years from now? Because that is kind of where we're at, is what do we need to expect and plan for now in the next 5 to 10 years?
So what we do is we look back on that experience study that's on there of June 30th of 2024. What we did at that point, and we do this every 4 years, is we look back at the actual experience of the plan. What happened? What really happened? And then we tweak our assumptions based upon what we think will happen going forward. And sometimes that has meant we've had to create lift on contribution rates because we see raises that are coming down the pike. And we see people continuing to live longer as mortality tables have increased. But to your point, you could have people pass away. So it's always a moving target. We just try to do the best we can in coming up with those actuarial assumptions to try to fund the plan to make sure the benefits promised those employees are there.
To be very pointed, is there a way that the budget chairman and the finance director and this committee can reasonably predict what our employer ADC rate is going to be with some hit or miss, a kind of a target? Because we're planning budgets, and as you know, this is having quite a negative impact on our budget this year, and our concern is not just this year, but next year and the following year and the following year, and at some point, the burden's going to get too great, and we're going to have to make some changes and adjustments. I think this committee and the mayor's office certainly would like to know what that looks like now before we get to that, in that situation. Does that make sense at all?
Yeah.
We're looking a little bit for some guidance here. If that's okay.
I hear you. One thing that's really hard is predicting the future.
I'm sorry?
It's hard to predict the future, right? If we knew that, we could all make quite a
And
nice
I'm not
living
asking
for
you to
ourselves.
do that.
But you get my point, right? Like some of this is, it's always, we take our snapshot at a moment in time, go with the data we have, try to calculate a reasonable rate as of that point, and then let that year play out funding the ADC that's been calculated, and then we repeat the process the next year. It really depends on, do your retirees keep living longer? Do you all give raises to your employees above our assumption? Do you have more turnover then? Does turnover start to pick up, right? How quickly are your employees churning? All those things, especially on a large pool like this where you've got 8,000 people total in the pool, those data points can change all the time. And so that's why we just take it in aggregate for the year, take the snapshot, and then try to make our best predictions going forward. I can't say for sure that your rate's always going to go up. I can't say for sure that your rate will go down. I do know that as long as that unfunded liability at the bottom of the page, if that does not have a bracket around it, that means it's a liability. That means it is a debt that we have to phase into the rate to pay off over time.
Okay, and so you've led perfectly into my last question. Define unfunded accrued liability, please. Give us some examples of what that looks like and to what extent this county can positively affect that by bringing it down.
Okay,
Thank you.
well, let me go here. So in the middle of the page, if you notice there's a number there, it's called normal cost. It's right above the total ADC, normal cost. The way I think about normal cost in as basic terms as I can provide is assume that all of our actuarial assumptions were perfect and that everybody got the raise that we thought they would get, everybody worked as much as we thought they would, everyone passed away when we thought they would, and the investment markets gave us exactly what we needed, exactly as we've assumed it at 6.75%. We know the world doesn't work that way, but that's essentially what normal cost tries to predict, okay? So in theory, would your rate ever be lower than the normal cost plus the administrative fee that we charge to operate the plan? In theory, no. Okay? So you're at a baseline, you're looking at least 11.61 plus 0.23, not assuming any of the unfunded liability we have to blend in. So those two are kind of already there. The unfunded liability in the rate actually ties down to how much we're paying it down as a part of that number at the bottom of the page, which is the unfunded liability we have to pay off in chunks of time over a 20-year increment. So the normal cost is a good way to go, well, that's about as low as it would ever get. The unfunded liability, what we try to do is when we have the ability to tighten, we will. But if you notice, we don't have anywhere on here where we're not, so the years out are 11, 12, 13, 14, 15. I mean, they're perfectly sequential. We didn't jump any of them because we could eliminate them. And what we try to do, because TCRS is conservatively managed, is we try to be less proactive in using up that asset and more aggressive in paying down the liability, because we can't predict the future, and we'd rather have some tools in our tool belt if and when a rainy day comes and we have an investment market that's giving us less than 1 or 2% for multiple years in a row. We've got some asset to work with to keep your cost managed. Whereas if we were to, like, we could drop your rate significantly if we used up every one of those tiers of asset with the brackets all at once. We could lower your rate. But if and when a rainy day comes and the market's not doing well and people are way outliving our assumptions, we have no tools left other than to make the rate rise to catch up with whatever we need to be bringing in. So I hope that helps.
I think it does. Let me make sure, let me just oversimplify this if I can. Basically, the unfunded accrued liability is those people on the pension plan who outlive their pension and who are yet still receiving a pension. Would that be accurate?
That's one factor.
That's enough. Thank you.
Another factor is the investment market being underperforming. Another factor is the inflation being more than we can pay in cost of living. So our cost of living is at the top of the scale. I'm going to make a joke. One of our former Treasury employees used to say, what would save the pension plan a lot of money is if when retirement checks went out, they went out with a pack of cigarette and a bottle of Jack Daniels, right? Because that would shorten life expectancies, which would ultimately save the pension plan. I'm being silly, but y'all get my point, right? Because as people outlive the assumption, then you're going to have less pressure on the plan. And when the assumptions are not met, then we have upward pressure on the plan. So hopefully that helps. I know I was a little silly there, but I hope that can kind of illustrate it. Yeah, go ahead.
No, I just wanted to provide a transition and ask, do you have this piece of paper for the hybrid plan you're about to, so we could, as we're going through that, kind of be thinking through the same analysis?
Well, you don't have any employees in it, so we don't have a rate to calculate.
Okay, that's fair.
Yeah.
Do you have any kind of pro forma type analysis?
Yeah. I'm gonna get there.
Perfect.
You're leading me up. You're setting me up right.
Thank you much.
Okay, so a couple things y'all could consider doing. Now, one thing is you could the rate's gonna go up. We're gonna pay whatever it is every year. This is obviously very valuable to employees. Having a non-contributory plan, employer funds 100%. It's a great recruitment tool. It's a great retention tool, no doubt. What y'all are doing is you're trying to balance out recruitment retention of good staff who you want to keep around and be able to bring them in the light of pressure on your overall budget, right? That's what y'all do in the budget committee. You're trying to balance those things out. And so what are some things that you could consider doing? And again, everything would only affect new hires after the date that it's implemented. So one thing you could consider doing is discontinuing that non-contributory status, meaning that new hires would pay 5% of their salary into the plan.
How long do you have to wait?
You could do that. It just has to be on a quarter.
On a quarter, so there's no, or maybe there is a set period of time, like 3 months, 6 months, before it can be effective.
Yeah, you can't turn it off one day and then hire a bunch of people the next day. So there is a little bit of lag time. But you want to do it on the first of a quarter. In most cases, it makes sense to do it at the beginning of a fiscal year.
I want to interject something there, though. That would be only affected anybody hired after.
Only
that
new
time.
hires.
Once you're in that system, you're basically locked in, the way I understand it. Is that correct, Michael?
You can.
So what we're talking about is not going to affect anybody's that's already hired and locked in with this.
Any existing employee is set in our legacy plan that we already have. Anything, just to reiterate, anything we talk about tonight is for new hires and for future budget years. And I'll circle back to saying one of the reasons I wanted that Drew went through this piece was so that everybody can understand how we get to the rate. It's not a dart thrown on a wall. It's an actually determined rate. And then what I wanted him to do tonight, excuse me, was not to try to convince us to change. It was to give this committee and this body options as we go forward. It could be that this body chooses to stay with what we got, and that's okay.
Yep.
It's going to be very expensive, and that's okay too. to point out, this rate on here is essentially our matching 401k rate. So this 13.62 that'll be next year, that is on every salary that the county pays. So every salary we make, and if it goes up 1%, that's the same cost as a 1% raise. And so as we're competing with employers, let's say the city of Murfreesboro, that gets brought up a lot of times on public safety, their match is 6 or 8% or something like that. Our match is 13.62. That's why this is so important as we consider to go forward and we look at it. And so I think really what Drew did all this to lead up to, what are your options to change, if you even want to change? And one of those is to be contributory. And another, what he's going to talk about is the hybrid plan, not to steal your thunder, but to oversimplify what we're doing. That is really the crux of what I wanted him to do, is give you all options if you wish to address any of those going forward as far as next budget year.
Sure. Yeah, one would be just have your new employees be contributory. The benefit structure is the same, still replacing 1.5% of salary per year worked. They just have paid in to help share on the burden of the funding of the plan. So that's not going to like immediately drop your rate. It's not going to immediately save everything. It's going to be based upon your turnover rate, and everybody who leaves is leaving non-contributory. You're bringing new people in as contributory. Think of it as of turning a ship very slowly in a river, right? So it's not like it's a quick turnaround, but it is over time. Employee dollars will start being expected to come into the plan, which takes some of the cost pressure, in theory, off of the employer rate over time. Again, not immediately. It's however quickly you turn over. So if you've got 3,300 employees active, how long does it take for all those to turn over where the new people come in as contributory? Okay? That's one option. Again, no pressure to do anything, but these are options that you could consider. Michael asked me a question, maybe one of y'all brought up a question about could you change the vesting schedule? So vesting currently is 5-year vest. That's consistent across TCRS with the exception of a few grandfathered plans that have a 10-year vesting. The law no longer allows an employer who's gone to 5-year to go back to 10. So once you're at 5-year vesting, that is the standard across the plan. And the truth is that wouldn't really help that much from a cost pressure because turnover, and you can ask your department heads this probably, turnover is not that rapid between years 5 and years 10. It's month 0 to year 5 is when people turn over. That is more likely when you're going to lose employees.
So what kind of drop would you typically, let's say, because right now, as you pointed out, there are no new hires, so there's no plan there. There's the old plan. Okay, let's say it's implemented hypothetically in the fiscal year.
Okay.
Okay, so that means it doesn't kick in until, I think Commissioner Gooch just showed me a slide that I hadn't studied or noticed. Something about 6 months, doesn't kick in for 6 months. So the current rate stays basically the same, or do we get a little bit of credit? Or, and then as new hires come on board, that pool starts to shift from legacy to new hire. I'll just call it a new hire plan.
Yeah.
And so it starts to shift. What kind of shift do you see typically in a county government like ours?
Yeah.
Okay, what kind of change would we ordinarily kind of see?
Yeah. So year 1, what we do is until we've had a chance to phase in the fact that you have a bunch of contributory employees in the analysis each year, is we take whatever the rate is, in this case 13.62, we subtract 5% from it, the employee will pay 5, the employer will pay the rest. That's the temporary process in that transition year. Then once there's enough data for the employer to have a ADC calculated, phasing in those employees who are required to contribute, you get one rate that knows that some of the dollars coming into the plan are from contributory employees, and you'll pay that rate across the population. Year 1, year 2, it's not going to affect the rate that much. It really isn't. But over time, you will see it slowly blend in and become a bigger and bigger factor. I will be transparent and say that some of the feedback we have gotten from employers who have gone down that path is they don't think the savings happens quickly enough. That's just from other employers that we have talked to, because once they do the valuation, knowing some employees are contributory and they phase it in, if you've got all the other rate pressures in there, there's no way just to drop the rate significantly. because you still have to, because in this case, the contributory employees are still in the same retirement plan. They're just required to pay in, but all the provisions, all the benefits are all the same.
But basically, they're going to make 5% less than what they're
That's right.
currently
Their
making.
take-home will be less because they are required to pay in.
So that's something I think we need to keep repeating. I see Ms. Stevenson back there. When we're hiring, the difference in the plan that we've got where our employees do not have to contribute, that is the difference between, for instance, Murfreesboro City's, what they're paying their police force versus what we're paying ours. Our people's insurance, they're not contributing. And that difference, it seems, unfortunately, that a lot of the newer hires are more interested in the pay on the front end. But as they get a little bit older, then they realize, hey, I'm going to need something to retire on. And our plan is much better. But at any rate, I want to keep pointing that out. That's one of the huge differences between us and this other plan.
Yeah, it's a value judgment, right? So we've seen employers that their employees complain about their salaries, but yet all health care coverage was funded by the employer, including family and retiree coverage, and they were a non-contributory TCRS plan, and they had enhancements to that for some of the public safety officers. And so the employers were complaining about salaries, but if you look across the board, they have like one of the richest benefit packages you could have, right? So to your point, it's finding that balance of what attracts employees, wants to keep employees here, but what also makes sense from a long-term perspective. All right, I'm going to dive into the PowerPoint, if that's okay. This will be quick. I'm not going to belabor this. This is another option you all can consider. And this is the plan that is for all new hires that are teachers, state employees already in effect, and then we've got about 30 local governments that have already enacted this particular plan. Again, there's no pressure on y'all to do this. It's just something for y'all to look at. So I'm going to skip through this. Really, TCRS, the state of Tennessee 401k, which y'all already use, and then our retirement education is kind of part of our Retire Ready Tennessee branding. Who are in the plan? Obviously, you got a lot of state employees, higher ed teachers required, judges, most of them are in, General Assembly members are in. The local governments elect to participate. That's why y'all have the ability to make some changes, because you all have some flexibility to your provisions and your structure. Again, we talked about this. TCRS is that defined benefit plan guaranteeing a lifetime of benefits once vesting and eligibility are met. You're guaranteeing the outcome based upon a formula of service and salary. What affects that? Again, it's the salary average, it's the years of service, the age at retirement, and then what the accrual factor is. And we talked about that. Y'all have a 1.5% accrual factor. That's the legacy plan formula. Our 401k plans are not a defined benefit. Basically, the dollars go in and whatever and however it's invested and however it grows is what that account balance will be worth in retirement. You all use our state of Tennessee plan already. That would stay intact. And it would be a feature potentially of the hybrid plan if you were to go to it. So what is the hybrid plan? If anybody drives a hybrid car, you know you really have two engines. You've got a gas engine and an electric engine, and they work in tandem to get you to your destination. Same thing is true with a hybrid retirement plan. You have a defined benefit piece, TCRS, and you have a 401k piece. Now again, to reiterate, this plan was effective for all new state employees and teachers in higher ed as of 7/1 of 2014. Local governments, it's optional if they want to make a change to this or not. There is no pressure on our side, but that is your all's decision as the governing body. Again, it only affects new hires after it's implemented. No current employees, retirees, anybody that's already in the pool would be affected by it. It's only new hires. And you do have a 6-month wait from the time you voted in before we can start putting people in it when they're newly hired. Actually, I'm going to go to this. This is a little easier for y'all to see. It's the same kind of chart. So you have 4 parts. You have 2 parts to TCRS, employer and employee. You have 2 parts to the 401k, employer and employee. The total going in is 16%, but the employee is responsible for 7 of that. That means the employer's total budget impact is 9%, and that is set and guaranteed year on year on year on year on year. So every year you can say 9% is what we have to budget for our hybrid employees in the retirement plan. That never changes. We have tools that allow us to keep that cost controlled at 9%, which I'll get into here in a second. But 9% is the employer's budget amount. The employees do have to be contributory to TCRS, and they are auto-enrolled in the state of Tennessee 401k at 2% of their salary, and they can change that at any time, up or down.
Drew, could you also touch on a piece of this, that an employee can take their 401k contributions with them, whereas right now, if you come and work here for 2 years, and we put in next year 13.62, and you leave after, let's say it's 4.5 years, you get nothing when you leave here. So I think there are pros and cons to both, but if you could touch on your 401k piece is your piece.
Yes, it's very good. So to the question the mayor asked earlier, if you have a bunch of people who come and don't work 5 years here, they don't ever vest, that works as an asset in your plan because there's never a benefit due because they're non-contributory and they didn't vest. It's all employer's money. The employer money stays in the pot. If you're in the hybrid plan, the employee can take 3 of the 4 parts with them when they leave. They can take their contributions to TCRS and all of the 401k money, both employer and employee dollars, that's their money as soon as the dollars hit the account. TCRS still has vesting at 5 years. The 401k part, the employer-funded part, is vested immediately. As soon as the dollars hit the account, it's theirs. Yes?
On the 2%, can the employee increase that number?
Sure. Yeah, it works like any 401k. They can go up to the IRS max.
And what is that?
This year, if you're under 50 years old, it's $24,500.
And Commissioner Gooch, we also here allow different section of IRS code. You can also max the 457 as well. So you can match both the 401k piece and the 457 piece. You can both do those Roth as well. So the state implemented that in January of last year.
Yeah.
So you could do another 23,500 or 24,500 in the 457 piece on top of the 401k is an option.
And the 457 is completely voluntary.
Yeah,
so the 401k is the component of the hybrid plan.
If the employee wanted to do 5% or say 6%, we're always at 5%.
Yes.
We don't match their total.
So the employer parts on the left-hand side are set.
Okay.
The employee has to do 5% to TCRS, then the 2% there, it's got a little asterisk on it, that could go up or down at the employee's discretion, and they can go up to that IRS limit if they want. So when this plan was designed, the General Assembly was battling back and forth between, do we want to keep a legacy pension plan in place, or do we want to go all 401k? And what they did was they compromised. They met in the middle, and they said, let's have aspects of both. You get the upside of the market, but it should be more affordable in the long run on the TCRS side because you're not guaranteeing exactly the same level of retirement benefit. And so what I'll touch on there is it's a 1% multiplier on the TCRS piece. Whereas remember what the legacy plan is 1.5. So that means the 1% multiplier in TCRS is replacing 1% of salary per year, whereas the legacy plan, it was 1.5%. Yes.
Take a hypothetical where you have 2 hires. One's under the legacy, the other is under the hybrid. Mm-hmm. Okay? Let's say the last day or the last day that legacy applies, that person is hired. The first day of the hybrid, the other person is hired. Okay, at the end of 20 years, I know there's some assumptions you have to build in, and you could go through those.
Yep.
Who has the most present value, and whose estate or portfolio has more money in it?
Good question. We have ran simulations on this. And so the best way to think of it is total income in retirement regardless of the source. Okay, so we have to do that. Because the legacy plan, it's basically just the defined benefit piece, and then if you saved in the 401k or the 457, that was voluntary. In the hybrid plan, you're required to be in the 401k, and the employer's pumping 5% into the 401k, right? So here's how we ran it. If you assume a 6% rate of return on the 401k money, which is conservative, but that's what we do, on a 30-year career, let's do 30 years, they're very comparable. And they were designed to be comparable. Now, if the employee does an extra percent, meaning the employee's putting in 3 to the 401k, the employer's still putting in 5, they have the same amount of service, that employee is going to have slightly more income in retirement because they're going to pull from their 401k and from TCRS. It will be slightly greater. If the employee does an additional percent, then it's going to continue to be greater. And we default into the target date fund for the 401k, and I'm using a 6% rate of return for these analysis. But if you look back since like the last 10 years, it's actually been averaging about 11%. So in theory, that's been way better. Now, we can't promise that in the future, right? Because we don't know what's going on over in the Gulf states and all that. So
you're saying theoretically the hybrid ends up a lot better,
it could be.
assuming investment returns are higher than your 675.
It could be. Now, the other thing that we have to control for here is salary. The higher the salary, the more likely the hybrid plan is advantageous because you're getting more compounding on higher dollars on the 401k side quickly. The lower the salary, the legacy plan tends to be a little stronger because you're getting guaranteed income and you don't have the same lift of the amount of dollars going into the 401k over the course of their career. Now, the percentages are the same, but from an income security perspective for a retiree.
That's only in the early period, right?
Yeah.
And basically, after you get past a certain period of time, the legacy, presumably the investment earnings, et cetera, depending on what you assume, in terms of investment earnings, are going to outshine, so to speak, the legacy by a fair amount, I'm guessing.
It all comes down to how that actually performs in reality. Because again, with the legacy plan, we're guaranteeing an outcome based upon a formula alone. Whereas the hybrid plan, we have one part that's the formula, and then we have another part that is the investment return piece. And again, just like we can't predict the future, we can't predict what the markets will do. But we try to average it out at a 6% overall rate of return to come up with what that comparison would look like. They're designed to be comparable to your initial question. They're designed to be comparable.
For that initial 30 years.
For in terms of total income in retirement, they're designed to be comparable.
Total income in retirement for that first 30-year period. After that,
the longer you're putting money into the 401k, the more that side of the plan, in theory, is going to help you. Yeah.
okay.
Yeah.
Are the investments in the legacy plan and the hybrid plan the same in your calculus?
For the TCRS piece, yes, because we're guaranteeing a benefit based on a formula. For the 401k piece, it's up to the employee to determine how they want to invest based upon the lineup, but we default them into what's known as a target date fund based upon their age and when roughly they'll turn age 65.
The reason I'm asking, would the legacy plan be a better plan potentially for an older demographic than the hybrid plan for a younger demographic? Is there a way that we can determine if one plan is more suitable to one demographic than to another? Does it give the county some advantages there?
Yeah, I would ask the question on, do your older employees who are currently employed, do they have longer longevities, and do your younger employees, trend-wise, look like they turn over more? That's probably the question to ask, because I do think there is a lot of comfort for employees who know, if I work here this long, I'm getting a guaranteed benefit for this, based on a legacy plan formula. But if you're hybrid, there's a little more skin in the game, because you're funding TCRS, but you also got to be paying attention to your investment return on the 401k throughout your career. So there is more activity needed from the employee side in a hybrid plan, I think. Whereas legacy members often go, I'll save a little extra, but I'm counting on that and Social Security to fund my retirement, right?
To Michael's point earlier, you're basically vested in more dollars up front versus if you left at the end of left at the end of 4.5 years, you end up with a lot more money. If you go 30 years, theoretically, you have the same amount, theoretically.
Yeah.
And if you go past 30 years in retirement, you are presumably to the good in the legacy plan. Is that fair? Is that a fair analysis?
I mean, they're designed to be comparable if you work 5 years, 10 years, 20, 30, 40, because your TCRS benefit's also going to go up, right? What's harder to predict is when people don't work straight through as to which plan's better. Like less service but vested, you tend to have a legacy benefit that tends to be better. Your people who come in mid-career, late career, and start working for the first time in a hybrid plan, they don't have the same runway for the 401k to grow as someone who starts at 23. So those are some of the data points that are hard to control for. The big takeaway for you all as a board is that they're designed to be similar. It's just how you get there is a two-part process here versus legacy, it's one. It's just the plan itself. All right, I'm going to touch on a couple of things real quick. I know we're going long here. Again, the hybrid plan formula, it's a 1% on the TCRS side. Again, we're using your salary and your service to calculate the benefit. Those are sample income replacement numbers for the TCRS piece alone if your average final salary is $50,000 a year, which we think is kind of a fair number to try to give a ballpark of. Okay, so they're going to be getting that monthly, and using our same assumptions of a 6% rate of return and sticking with the 5% employer money, the 2% employee money. That's what we expect the balance to be on the 401k side for this same employee who worked 30 years. So again, they're going to pull from TCRS, and they're going to pull from that account balance to replace their income. All right, the last thing I'll touch on is the cost controls. How do we guarantee that the TCRS piece is always 9%, or the total is 9%, when the TCRS part, if y'all remember, was 4%? So what we do is we still do an actuarial evaluation on the hybrid population. We come up with a rate. Anything that's, like if that rate is initially going to be below 4%, then what we do is you pay the rate, and then anything between that number and 4, we're putting into a stabilization reserve account, which is like a rainy day fund. That will be our first cost control if we ever have to kick them in. We bring the money from the rainy day fund to keep y'all at 4% no matter what. So that's the stabilization reserve piece. The next thing is we can adjust COLA. We don't necessarily have to pay a COLA to this population based upon the way it was designed from the beginning to retirees. The other thing we can do is we can flip-flop the contributions between TCRS at 4% and the 401k at 5%. We can just flip those numbers if we choose to, and you still budget 9%. It's just where it goes is two different places, but it's still a 9% impact on the employer. And then we have some other things that we can do in terms of adjusting the contribution 1%. We can eventually freeze the plan. We stress tested this when we designed it against the 2008-2009 economic downturn to go, okay, well, how well did it do? What did we have to do? And the cost controls that we did have to use in order where we used up all the stabilization reserve and we had to suspend COLA for a year. And that was when the market lost 25, 26% in the TCRS fund. So we feel pretty strong that this thing can withstand, some bumps along the way with the investment markets if it has to. But it's, again, because we've got the cost controls built in it from the way it was designed from the beginning, you all budget 9% year on year on year. The employees do have to pay in, and there is a 401k component they've got to be involved with as well that the employer will help fund. But overall, we still think it's a very strong retirement plan. It's better than what most people are going to see in the private sector for sure. But again, compared to your non-contributory legacy plan, which would feel much more like a Cadillac type retirement vehicle you currently have, this is an option you could go to for new hires going forward. Again, no pressure from us, just going through options. If y'all have questions or you're interested in us drafting up a resolution for y'all to look at, James's contact information, he's here as well, is on the screen. And we're happy to field any questions y'all have as you all do some long-term planning about what you want your retirement plan to look like in light of what you can fund.
I want to interject something here, and I'm asking this to our committee. He has volunteered to come to our full commission meeting to do this same presentation. Now, course, you've lived through this once, or not quite through it, but I think this is very important. I personally would lean toward asking him to come to do a presentation, maybe wait till the end of the presentation to do questioning, but I want to hear from the committee your thoughts on that as far as inviting him to the full commission to do this presentation.
I think it'd be a great idea.
Anybody else? Anybody against us doing that? Well, in that case, Drew, we're going to ask you to show up at our full commission meeting.
Okay.
If that's okay.
Wait just a second, okay? I control the agenda, okay? So
I thought it
you
was
need to
already on there,
clear that
excuse
for
me.
Is there any particular time element involved in this? If you came before the full commission in April, May, June, or July, is there any particular time element involved in this, Michael?
Well, he touched on it a little bit, and I'll reiterate. I think if this is something we definitely want to be proactive on, because it is not an immediate change, and Drew mentioned that. But to answer your question, as we look at being proactive, if we wanted to make a change today, which that's not what we're doing tonight, it would be 6 months minimum to go to the hybrid plan. So we could not implement this. 6 months would be minimum. And I would highly, highly suggest to start this either on a quarter or on a July 1, which I think is typically what most people do. So really, I think what we're looking at as we plan, and the reason I asked Drew to come, and I really do appreciate everybody sitting through this, because it's not the most fun topic, but it's one of the largest dollar amounts we talk about. Like I said, this year it's $12 million to the budget, and it's going to be at least an additional $2 million plus next year on top of that. And so as we look at this, if we can talk about it this budget cycle, it's something we could do January 1 or July 1 of next year, I think is the timeline you're talking about. And that's why we always talk about all these changes we want to make to the budget. I think Commissioner Piercy mentioned wheel tax one time. We were always like, well, mention it next year, and we talk about those types of things. So this was kind of our way to try to be proactive and give y'all enough lead time if you wanted to make a change. Again, you don't have to, but I think it would be minimum 6 months. Drew, is that?
That's correct.
I think
so.
minimum.
So what a lot of employers do is they try to vote it in before a July 1, knowing that they can start hiring people into it on like January 1, or they try to vote it in like December in order to it go effective July 1 of the following fiscal year. They try to time it up for budget reasons. Again, the 13.6 is going to be in the budget because that's all you have right now, right? So again, I'm not here to sell y'all on anything, all right? If you like what you have, you feel comfortable with it, no changes are needed. And we'll come back often if need be. This can push into the fall if you need to keep having conversations, not a problem.
My thought process, Mr. Chairman, dealt with, like, next week, we'll be here till midnight, okay? And I don't want to add something like this to an agenda that everyone will be brain dead by the end of that meeting. My thought process deals with July. Our July meeting has really very little on the agenda, if anything, and it would be a perfect opportunity for this to be presented in July. I'm not sure that timing works out, Michael.
Well, I think July would be, depending on how the budget cycle goes, July could be an excellent time. Also, if you remember, we have 2 meetings in June. So I think what we could do is if this committee wishes to, as the budget committee takes the first 2 or 3 weeks in April and we work through the budget as a group like we do every year, and we see what those costs are going to be, we see what the deficits are going to be, you could add this to your June agenda depending on how long it is. Because remember, that first meeting in June, we don't vote on the budget. That's a special meeting at the end of June. And I think depending on how that goes, how urgent this committee feels it needs to be, we could either do June, depending on how long that agenda is. July would almost be one of the only things on the agenda, depending on if we said we want to dedicate an entire half of the meeting to it. I think July would be definitely appropriate unless the budget committee found some reason to speed that up throughout that process.
But to both y'all's point, this stuff is dense, right? This isn't easy to cover. It's hard to digest if you're not in the pension world. And so I think taking your time with it and working through it, and if we need to do this multiple times, that's fine. That's what we're here for. That's what our team does. So yeah, I think y'all be methodical as to how you want to address any of this stuff, whether it's keeping things as is and you vet everything and you're fine staying where you are, going contributory is an option, looking at a different plan structure is an option, right?
June or July, either one of those would work for me.
Chairman Phillips, I want to interject something there. I actually was trying to get him off the agenda. I thought he was already slated to be on there. Please forgive me for that oversight. But, Drew, anything else?
So this 13 point whatever number, we basically, that's going to be set basically as our number, presumably, or is there a way that could be deferred as of, so we've had a chance to look at this and kind of assess?
This is your minimum number that we have to pay for the 26-27 year. You'll have to take a vote. That's the next item tonight. That is the minimum number to set. Now, the reason we bring it for a vote is not so that we can lower it. It's in the past, if that number has went down, a lot of counties will continue to pay the same rate because it's already budgeted to help that net pension liability that Drew mentioned. But yeah, that's the minimum number we're going to have to pay next year because the state law here dictates that we pay the actuarial rate. So that is our number for next year, assuming that we don't try to implement something in January 1 of 27. Does that change our number? But it probably will not change it materially. It's going to be very close. And I want to reiterate something.
That's based upon the snapshot we took June 30th of 2025, which will fund your 26-27 rate. So your population's already in it. So the 13.6 is there.
We would presumably vote for this 13 whatever number. And then if it were to be set up before July 1st, then it would effective January 1st.
For new hires only.
For new hires only. Then at that point, in the next cycle, we would start adjusting slightly.
Yeah, so I need to mention this. So I talked about if you go contributory, we phase it into the same actuarial valuation. If you go hybrid, we do two separate valuations. So what's likely to happen, just being fully transparent out of the gate, your legacy group, as you get more retirees and you have fewer actives, because we're not going to be adding any more to it, that rate will tend to go up. But all of your new people are coming in where you're budgeting 9. So the overall budget impact to your payroll budget and to funding retirement in its aggregate will tend to be less, right? So for example, the state, we changed in 2014. The state's rate at that time for its legacy population was in the 14-15% range. It's now in the 22-23% range. But it's on an ever and ever shrinking group of active employees. And at this point, we currently have more active hybrid employees at the state than we have active legacy members of the state. And so it's saved over $2 billion over that period, even though the employer rate on legacy has gone up. Because you're bringing everybody new in.
It's because your marginal rate has gone down.
Yeah, your total contribution for everybody combined in both plans has gone down.
Thank you, Mr.
All right, thank you all.
Drew, I appreciate it.
Yeah.
We'll get with you as far as a date to return.
Okay.
Thank you.
Thanks for y'all's time.
One thing I will point out is Tennessee is known as one of the few states in the nation that actually has a fully funded retirement. A lot of the states are in dire straits because of this. Anyway, let's move on to our next item, which is TCRS rate for fiscal year 27 budget. And as you've already heard, $13.62.
13.62%.
62, excuse me. Anyway, we've looked at this in the past, and as he noted, there have been times that the rate had dropped, and we chose to continue to pay that rate, so we were a little bit ahead. The reason I mention that is you could actually have a higher percentage than the 13.62 if you wanted to, but
We cannot afford that, so please do not make that motion.
well, I'm just telling you exactly, what you could or could not do, but you cannot make it any lower.
That's correct.
Any discussion? Hearing no discussion, I'm going to ask for a motion to move to 13.62% rate. Do I hear that motion?
So moved.
I have a motion, Commissioner Gooch.
Second.
Second, Mr. Sereno. Further discussion? Call roll, please.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris,
Yes.
Commissioner Irvin, Commissioner Johnson, Commissioner Piercy,
Yes.
Chairman P.
Yes, motion carries. Thank you. Now, item 8, funding request for the county clerk renovations and the EMS buildings, FF&E in Smyrna. And who's going to present that?
I can give an overview, and then I think in the audience tonight, we've got Brian Gaither, Lisa Kroll, Eric Hennessy is also hiding behind a pole back there. But what this funding request is, it did go to property management. Recently, we opened bids for the EMS station off of Weekly Lane or Road, or I think is it I Street actually? It's off of Weekly Road. And then part of those also bids included some renovations for an additional drive-through lane at the county clerk's office in Smyrna, at the Smyrna location, also off Weekly. The construction of the EMS station is already funded, so that we've already funded that prior. But what is not funded, this body only funded the design costs for everything else for the county clerk renovation. So tonight, what the request is for $475,000, and it's going to fund several things. I'm going to list those in no particular order. But it's going to fund the construction of the additional drive-through lane at the county clerk's office. It's also going to fund a renovation of a tube system at the Murfreesboro office. The county clerk put that in her budget request for this year. We've asked her to pull that out and put it as part of this request because it is, I think it's original to the facility, but it's aging and breaking. Excuse me, got the hiccups. It also covers the FF&E and low voltage for the county clerk renovation and the EMS building down there on Weekly. The other thing we're trying to do with this money is also get cameras and Wi-Fi to the convenience center on Weekly as well. So that, I listed a lot of stuff there, but that's what would be in the $475,000 funding request for that tonight. Now, I've got a couple of options of where that could come from for this body. That's why there's not an amendment on your iPad tonight, because there's no right or wrong place for this to come from. But I think the two choices I would recommend would be you could take this out of unassigned fund balance, which is where we took the design cost of the county clerk. However, there's another option is we have some extra investment income that we were very conservative in budgeting, that we've kind of treated that like one-time money. And so you could take some extra investment income and to fund this tonight, and that way you wouldn't touch unassigned fund balance. That's also an option for this body.
Where's the investment income? Where?
Investment income is in the general fund, but we obviously we're very conservative in budgeting that, so that's an option too. That would probably be my recommendation, to take it out of there. That way we don't have to touch unassigned fund balance, but either one of those are good options. We did plan for this as we've looked for, we knew this was coming back when we put the bids out. Purchasing has approved these bids and awarded these bids contingent upon funding by this body and by the full commission next week.
And what was the number again?
475,000. The other thing I will add is I rounded that number. It's not exactly 475. I rounded to the nearest thousand there. And one of the things we've always done on even our projects is we have several projects coming down the line is any leftover from this project will move to the next one. And for example, transfer station to forensic center to BOA, those types of things, very similar to schools. So I don't want you to think they're going to go spend 475. Those are set by bid limits. We're only going to spend what they need. Any excess will be moved to another project, or any excess could be moved back to the general fund, either way. But typically, we move those on to design or the construction cost of the next project that the county has.
The FF&E was for EMS and what else?
And the county clerk building. She has, part of that drive-through has some additional security cameras, has, some low voltage work along with those security systems and intercoms. So it'll fund that as well.
Any other questions? You recognize?
I guess it would be from Michael. I believe you said Weekly Lane Convenience Center.
Yes, one of the requests we had from this committee, and I believe it was Chairman P who brought it up, was to try to look at getting cameras or internet, well, the cameras, but we needed internet or low voltage equipment to do the recording of these convenience centers. And so we were going to try to do that with this pot of money, if we had a little bit of leftover from the 475, was we're already having to run low voltage or fiber internet to the EMS station and upgrade the county clerk building around there with the forensic center. With them being all near the same campus, we were going to try to use this piece, if we could, to get internet, which would allow us to do cameras at that convenience center on weekly.
So we're going to use this as a pilot program for the convenience center?
I don't know if it would be a pilot. It was just requested, I think, by this body to look at getting cameras there. We don't have to do that, but that was my understanding of the request.
I was thinking the request for cameras was at all the convenience centers. Was that not right, Mr. P?
It is. It's just that this was an opportunity to go ahead and get one of them funded. You remember the other night I asked Matt what his estimate on costs was, and this is just preliminary. So don't hold him or me to this, but it's around $60,000. If we can save on that by doing it sooner.
We were going to try to piggyback off of the construction providers as they were running fiber and cable for us to try to get this site cheaper because we already had workers there. Chairman P's right. I believe that estimate was $60,000 plus per site. And so we were just going to try to take one off the list and I guess in your case, pilot it, but hopefully at a lot cheaper rate because we already had the equipment and the work out there was the goal, or to try for that.
Okay, thank you.
Any further questions? Commissioner Johnson?
Okay, you need a motion?
I do.
Michael, you had a recommendation, correct?
Yes, I believe I would just use extra investment income for this and amend the general fund for $475,000 and to take this from the investment income.
I move we accept that recommendation.
Okay, I have a motion. Do I hear a second?
Second.
Need a second. Any further discussion? Call roll, please.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris,
Yes.
Commissioner Irvin, Commissioner Johnson, Commissioner Piercy,
Yes.
Chairman P.
Yes, motion carries. All right. Item 9, reappraisal plan and MOU. And I don't see anyone here to cover that right now. Let's pass on that and we'll, excuse me, our attorney's coming up.
Good evening, committee members. I will present this because I helped draft the resolution. This went through steering on Monday. It is every 4 years the county commission has to approve the reappraisal plan. That's what this resolution does. It also attaches a memorandum of understanding between the county and the DPA, the Division of Property Assessments, with the comptroller, and approves that. My understanding in being on emails between the DPA and the property assessor is that the DPA has approved this reappraisal plan, and now it has to be put forth before this body and then the commission for approval. If you have questions about the substance of the reappraisal plan, I'm not really fit to answer that. You would need to ask the property assessor that, but I can verify that the Division of Property Assessments, which is a branch of the comptroller's office, has approved what you have before you. And I guess the request would be to just approve this resolution and send it along to the commission.
Is there an increased cost on this plan?
That might be a question for Michael. I know that on your next item on your agenda is a budget amendment for the reappraisal, so we might want to wait for him to come in and answer that.
Any other questions while we're waiting on Michael to, you're recognized, Commissioner Gooch.
Thank you, Mr. Chair. So the property assessor agrees with this, or did he come up with the plan? Is that?
Yes, so he started a draft of the plan, and then he sent it to the Division of Property Assessments. They had requested changes. He made those changes, and then they have signed off on it.
Okay.
Any other questions? We'll give Michael a minute or two here, and Well,
But do
while
you
we're,
think that the next budget amendment is the cost?
Okay.
The next budget amendment is unrelated to this. There could be an increased cost to this appraisal. I gotta find the page. I did not draft this, but I believe there is an increased cost with staffing in this page. I just don't know where it's at. Did you tell him?
oh, he's looking for that. I do.
I found the page I was looking for. It is page 27. So what this does is you see in here that the assessment personnel, it's on page 27. I do know I don't know exactly what time. Sonia may know ahead of me. I do know earlier this year, Rob had 2 open positions, and I believe he was posted those or was going to fill those. I don't know if he's done that. He has not. I do not know tonight. I know Rob was asked to be here, but I don't know if those 3 positions that are vacant on that page that say new hire, if those are existing positions or if he's going to request new. I just don't know the answer to that. That would be to answer your question, Commissioner Gooch, that would be the only increased cost I'm aware of with this reappraisal.
I'm going to ask Ms. Stevenson, and you can nod to me. Do you know if he's filled those positions or if they're open? They're open? Okay, so there will not be an increased cost for those 3. Was her response that those positions are open? So that was the question I had. I was worried about staffing and if we were going to need to add some, because in the past when we've looked at that, he had requested increased staffing.
The other thing I can do is between now and Thursday, I can get with Sonia and we can confirm if those are still open or vacant for sure, to see if anything between now and Thursday, if this committee would like, but that's the only cost I'm aware of, Commissioner.
Okay. Any further discussion from the committee? If not, I'm going to request a motion, and you can make that contingent upon us hearing directly from the assessor.
So moved.
I have a motion and a second. All right. This is to approve the reappraisal plan and the MOU. Any further discussion? Call roll, please.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris,
Yes.
Commissioner Irvin, Commissioner Johnson,
Yes.
Commissioner Piercy,
Yes.
Chairman P.
Yes, motion carries. Item 10, general fund budget amendment for reappraisal.
So I can speak to this. This is just a budget transfer for the property assessor's office, unrelated to what you just approved. It's a transfer within his budget, but because it's over $1,000, it has to come to this committee.
So moved.
I have a motion and a second. And Michael, read out what this is for exactly, so people at home know.
So this decreases the property assessor's furniture and fixtures line item by $5,500 and increases his data processing services by $5,500. It does not affect anything in fund balance, but it just transfers $5,500 from his furniture line to his data processing services line.
Okay, we have a motion and a second. Any further discussion? Call roll.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris,
Yes.
Commissioner Irvin, Commissioner Johnson, Commissioner Piercy,
Yes.
Chairman P.
Yes, motion carries. Item 11, 440 Enon Springs lease.
Thank you, Mr. Chairman. What you have before you is an amendment to a fairly old lease agreement regarding an ambulance service station in the town of Smyrna. The lease originally was from 2026. This got brought up because the insurance department was reviewing various leases for county property and other leases that were leasing property from others to make sure that the right insurance is in place. And it was discovered that there were a couple ministerial errors in that lease from 2006. And so this is just a cleanup lease. It gets the term correct to allow us to lease that property through 2036 and not 2026 as stated in the original lease. And it also cleans up a ministerial error in the address of the property being leased. This has already been approved, I believe, by the town of Smyrna to amend the lease, so it's really just form over substance, and we'd ask that you just approve this minor change.
Okay, you've heard, I have a motion
Second.
and a second. Further discussion?
And what's the rent?
Of the original lease, I don't have that in front of me. It's probably something like $0 or $1 a year because it's with the town of Smyrna. It's their property that we're leasing from them or vice versa. We're leasing from the town of Smyrna.
Do we have any additional liability on this?
No, not any more than what we regularly have, and I believe our insurance department covers insurance on the property.
Okay.
Further discussion? We have a motion on this, don't we? Well, since there may be a cost involved, call roll.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris,
Yes.
Commissioner Irvin, Commissioner Johnson, Commissioner Piercy,
Yes.
Chairman P.
Yes, motion carries. Next is Lascassas Community Center lease.
Thank you, Mr. Chairman. This item and the item right after it pertain to the same piece of property. This is property located off of Lascassas Pike where the Lascassas Public Health and Safety Building is. If you were to pull up, the better picture is on actually item 13 on your SharePoint with the community sports lease. And if you were to pull that up and go to the very last page, it gives a graphic overview of the parcel in question. I would direct your attention to that so that you can see what is being leased. This parcel itself will be leased to two separate entities. One is the community center out there, which is a nonprofit organization, and the other is a community sports nonprofit organization who is going to run a little league / baseball field events, etc. On this exhibit, you will see designated in orange is the public safety building. That is obviously not part of this lease. That is going to remain county property. The blue shaded area is what will be leased to the community sports organization. That's where the baseball fields are. The green area is going to be leased to the Lascassas Community Center. I believe that they have been out there already, and this is just to shore it up and formalize the lease. And then the area in purple is going to be leased to the community center as well for events or other activities, green space, and they've committed to allow for it to be used for overflow parking for the baseball fields as well when there are a large number of people that are gathering for events for that. So these are standard leases that the county uses in instances like this. The community center and the community sports organization have worked together on these leases and have both approved them. So you can take them one after the other if you'd like. The lease term.
Can we take these together in your opinion?
I think that that's fine. Yes, yes. It's $1 per year, and there's standard provisions in here for the use and occupancy, the repair and maintenance, and other standard terms that we have in here for leases of this nature.
If it's,
Can we include both items 12 and 13?
we can.
The same?
Yes, sir, we can.
I do have a comment. The community center has taken responsibility of the park that's out there too for maintenance. I don't think that's on there, but it's no big deal. But I just wanted to people to know that.
All right.
What part, if you have that, do you have that exhibit? Here, I'll show it to you. What part is? Yeah, send us a bill. And I just noticed in here that I think we were going back and forth on this as to the term of the lease, whether it was going to be a 10-year lease, 20-year lease, a year-to-year lease. I think what we've done typically in here is a 10-year lease, I think would be fine. Now, we have an automatic right to terminate for convenience upon proper notice, but that's what would be my recommendation, to insert a 10-year term in there. And again, you can take these up together. We'd ask that you approve both of these since they work in tandem.
Any other discussion? If not, I'm entertaining a motion to approve both these leases. I have a motion to approve the leases on both 13 and 12, the Lascassas Community Center and the sports.
Can you specify a number of years in your motion for us?
Yeah, it'll be for 10 years, 10-year lease.
Is that okay, Commissioner? Is that okay, Commissioner Johnson?
Yeah, we did. I believe, excuse me, I thought it was Commissioner Sereno. I might be mistaken. Was there a second? I'll second. We do have a second with the 10-year lease agreement. Commissioner Piercy.
Will there be an option to renew?
Let me look at the lease term. There is not currently any language in here about an option to renew. I'm happy to include that in both leases, that we can do by mutual agreement of the parties to renew. We can have that expressly in there, or we can have an option for the tenant to request renewal for additional 10-year term upon providing so many days' notice prior to the expiration of the current term.
Either way will be fine, but we intend for this to last more than a 10-year term. So.
Well, I'm happy to, assuming that the motion in the second includes that, I think that the better route then would be to give the tenant the option to provide notice of renewal prior to maybe 90 days to the expiration of the then current term for another 10 years. I can include that.
That'd be fine.
Mr. Johnson is saying that he does agree to that. How about our second? Commissioner Gooch also agrees to that. So this will be renewable and be written into the contract. Any further discussion? Call roll, please.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris,
Yes.
Commissioner Irvin, Commissioner Johnson, Commissioner Piercy,
I'm going to have to abstain because I signed one of the contracts for the community center.
Chairman P.
Yes, motion carries. Thank you, Nick. Has that got you? We got one more.
Two other items, if I could, while I'm up here. The first is down on number 29. It deals with opioid board settlement acceptance. There's a resolution that is before you. This has gone through steering. This is related to the county's opioid litigations that it's involved in and has been involved in for many years. We've been settling over the years with various pharmaceutical companies. I think it's coming to an end with all these settlements. There could be more, but this settlement is for 6 remaining defendants that was in a multi-district litigation, and so this just is asking you to accept a settlement that's been negotiated by the county's outside opioid counsel. We anticipate that this will bring in roughly around $50,000 for use of the county for opioid abatement issues.
I have a motion and a second to accept these funds.
Could you summarize the terms of the settlement briefly?
So I did not negotiate it. It's from our outside counsel, and the settlement is actually put online, and they just asked the mayor to sign it. And I said, well, we have to get the commission to approve it first, and the mayor's office said that obviously that's correct. And so I don't have the full. It's probably a pretty long settlement, but my understanding from the opioid counsel, it's similar to all the other settlements we've agreed to in the past with this multi-district litigation. I don't know when the money would come. I think that there's a pot of around $97 million that'll have to be split up to the various local governments that are participating within the litigation.
Is it available online so that someone that's watching can view it?
I'm not sure.
Could it be put online before the county commission meeting?
I can check on that, and I can include it if I can get it from the opioid counsel. I'm sure I can.
Okay, thank you.
Yes, sir.
Any further discussion? I have a motion and a second on that. Call roll, please.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris, Commissioner Irvin, Commissioner Johnson, Commissioner Piercy,
Yes.
Chairman P.
Yes, motion carries. Go ahead with your other.
Thank you, Mr. Chairman. The last item is for another business item. I appeared before you all last month on the Bank of America building with respect to exercising our first option to extend it for an additional 30 days, and the commission approved that. Also approved an additional deposit of $100,000 for that extension. This is all pursuant to the agreements that have been in place with the Bank of America building owner. That 30 days is coming up for expiration after our next commission meeting, and so we need to, assuming the body wants to continue moving forward with this purchase, we need to approve the exercising of our second extension option for another 30 days. I've spoken to the architect, and they're still in the planning phase, but there is some good progress being made. The hope is that in the next month or two, I think, that they'll have some firmer numbers to present to the committee, to the commission on firm renovation costs. Now, it's not going to be the exact number, but the idea from KSA was to give the commission some idea of the renovation costs. And so we're just exercising our rights under the agreement to allow that process to continue to occur. So I think the request would be to approve exercising our second option, 30-day extension option, and for an additional escrow deposit of another $100,000.
Any questions from the committee? Okay.
We need to get this going.
Okay. Do I hear a second? Okay. Now, I have a question, Nick.
Sir.
There's been some discussion about the parking lot. Is there what is going on with the parking lot? Explain that.
Happy to do that. So the parking lot is currently, there's some legal disputes about use of the parking lot and traversing from Main Street over to the other end. The current owner is in litigation with owners of the buildings that are on the square that back up to that parking lot. Because of the interest of the county in making this purchase, we have been involved in those discussions as well, because if we take the property in a purchase, we will be affected by that litigation. So we have been working in good faith to try and resolve that issue, and it mainly pertains to ingress and egress easements for the building owners that affront the square and then back up to that parking lot. Progress is being made on that. The idea is that we will hopefully have a global resolution of all this before closing so that we can take clean title to that. And I anticipate that that will happen based on my discussions with counsel involved in that litigation.
How would that affect, or would this, whatever the settlement turns out, one way or the other, how would that affect us with the contract that we have? Would that be something if, for instance, it was something we decided we didn't want that would allow us to get out of the contract with BOA, or?
Well, I think we've got to keep moving on towards the closing. I anticipate that we will reach a resolution on that. I can also tell you, Mr. Chairman, that we have been in close contact with Bart Klein and KSA, and he's developed some plans to hopefully appease the property owners that back up to our property. Really, they just want ingress and egress easements to allow for their tenants to go through the little alley. I call it an alleyway, but it's that little strip right there. And if you've been out there, you see that there are orange, they're called jersey blocks or something, that they're the cones, or that are barricades rather. And that's kind of part of the subject of the dispute going on there. So in the county's renovation plans, that whole parking lot's going to be redone, and it's going to have some gated access for parking for employees, and it's just making sure that that aligns with what the interests of the owners behind us are. So is there a way to close on the property, taking it subject to the litigation? Probably, but in my eyes, we want to resolve this and get it all settled and done so that everybody knows what their respective rights are once we take the property and start the renovations.
So you think that the litigation, one way or the other, would not matter as far as this contract goes?
It will have an effect if we can't resolve it. I can't tell you what that effect is as I stand here today, whether we want to take the property subject to the litigation and then become part of the litigation itself, which we're not a party in right now. It's between the current owner and the other owners behind us. But the idea is to resolve it so that there's not a cloud on title and we can close on the property.
Any questions? Commissioner Piercy?
It would appear to me that we're not the hangup for moving forward, so why would the $100,000 not be void until that issue is settled?
So I think that is partly true. So that is existing. We didn't create that mess. Understood. I do know that there is a true interest in getting the commission firmer numbers as to the renovation cost before it pulls the trigger on closing on the property. And I know that KSA has been working on those design elements and design plans. The purchasing committee has engaged a construction manager at risk to provide some pre-construction services so that they can go out to get some rough bids from contractors to say, hey, here's how much it's going to cost. You all remember Mr. Klein presented a very long presentation a number of months ago with some costs and some graphics. And again, those were very conservative costs. And so the idea was to allow the design phase to kind of develop. We've already, I think, funded the design phase, Michael, through KSA. So they're actively working. The county is paying Bart Klein to do these design renovation schematics and come up with cost. And that still is not done yet. And they're working diligently on it, but it's just not ready yet. And so the commission probably wants to have that information before it decides to spend this money on the building.
Can we make a motion contingent upon this lawsuit being settled to send this to the full commission?
What I would suggest is I'm happy to look at that for the commission meeting. So I'd say get it out of this committee. Let's get it to commission.
The problem's going to be if that motion is made, I don't believe this lawsuit's going to be settled by Thursday.
Yeah, it's not.
And so I wouldn't be able to release the $100,000 earnest money earnest money check, which I have to release Friday morning if that was put on there that the lawsuit has to be resolved before I could release that earnest money check, which then we would forfeit the remainder of the earnest money.
And the contract would be terminated. If we don't exercise our option, that the contract dies.
But what we could do is bring it out of this committee, and then Nick could give a more detailed or a different update at commission and see where we are next week on Thursday.
Yeah.
I'm not trying to hold this up, but, if I'm paying X number of dollars for property, I want to know exactly what I'm buying. If they're telling me they're selling me that parking lot and they're in litigation and don't own it, then to me, that's a reason to not have the contract.
So just to clarify, so they do own it. They do own it. That parking lot has been in different forms over the many decades, and the claim from the property owners that abut the Bank of America property parking lot is that that they have been using it for so long that they have adversely possessed their right to ingress and egress, and that we can't monkey with that. We have to give them both a lane of ingress and egress out, and right now it's a pretty tight window. You can fit 2 cars in there. The idea is just coming up to an engineering, agreeable engineering parking design that suits everybody. And so I can tell you that it's not just us that are interested in this. The owners behind us are, and then the Bank of America buildings owners are. They've got title companies involved. There's a lot of interest on trying to get this resolved. And I will tell you that no part of the settlement is going to involve us paying any additional money to the people that own the buildings that are complaining about this. If anything, the only thing that we're working out is the future use of that little alleyway between Main Street and Vine. That's really what's at issue here. And I feel comfortable that we're getting to a workable solution. I've conversed with the county mayor's office, conversed with KSA, and I'm in constant contact with the lawyers on the other side.
Can you address that at our full commission meeting?
Sure, happy to.
Mr. Chairman,
You're recognized.
thank you. How much are we into it so far?
Right now, you're into it at $250,000. And if
Non-refundable.
non-refundable. And if you approve this and then the commission approves it next week, that'll bring it up to $350,000.
And what's the drop dead date, so to speak?
So let's go through this together. So our first extension is ending on Friday, April 17th. Our commission meeting is the day before. Assuming that we approve the extension, that elongates it to May 17th, which puts us 3 days after the May commission meeting on May 14th. We've got one last extension that we can exercise then as well for another $100,000 that puts us into June. puts us to June 16th. The commission meets on June 11th, a couple days before, and at June 11th, that's the drop dead date of when we need to crap or get off the pot, is kind of the expression, right? So if we don't, we refund, we forfeit all of our money that we put up for the deposit.
And at that point, we would have paid,
What's that?
at that point, we would have theoretically paid
$450,000.
$450,000. Okay, so I hadn't, other than your report, which I appreciate, we haven't heard from Bart in a month or two. It'd be great to hear from Bart, or not, I'm not picking on Bart or his representative, you know, someone to come in and say, this is where we are, this is likely to move forward or not.
I'm happy to email Bart tomorrow and say that there was a request that next month at a committee meetings that he provide some updates on what's going on. Would that be fair?
Yeah, that'd be great. Yeah, so it's something along those lines, because I'm candidly not keen about just keep writing $100,000 checks for not knowing what's going on, and at the end of the day, having $450,000, you know, sitting out there that could go poof if we can't resolve this lawsuit before then, is my view. This needs to get resolved, and there's, you know, some basic costs put in place, things along those lines. I'm just not keen about continuing to write, like I said, $100,000 checks with no, you know, no reports, nothing.
Understood. I'll email him tomorrow morning. Yes, sir.
Since I brought this up, my suggestion is for us to go ahead and forward this to the full commission, and you know, we should get some resolution or at least some more explanations in. Bart, by the way, at purchasing has talked to us about the BOA building and where we're at. So we are some of us are getting some updates on it. So things so far, the reports we've got back were favorable. So some things here and there that had to be repaired that we weren't looking for, but other things looking good. Any other discussion? We have a motion, we have a second. Call roll, please.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris,
No.
Commissioner Irvin, Commissioner Johnson,
Yes.
Commissioner Piercy,
Yes.
Chairman P.
Yes.
Motion passed. Sorry.
Thank you. All right. Thank you, Nick. Next item is the Highway Fund Budget Amendment. If Mary had come by herself, we'd probably let her come on up earlier, but since you were here, we wanted to entertain you a while.
Take that into consideration for the next meeting. Good evening, everyone. What I have for you tonight is a budget amendment for a generator grant that we have been working on for quite some time, 2022 or so. I think it came through here for signatures for the grant. We've been awarded that grant, so now we need to move some money around. And it is a 75% federal funded, 20% state funded, and 5% we will be responsible for from the highway department. And what this generator will do will get us electricity if something happens to our line power. So it was approved at the road board meeting on Monday, and I have it here for you tonight.
Second.
Have a motion and a second. Any further discussion? Call roll, please.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris,
Yes.
Commissioner Irvin, Commissioner Johnson,
Absolutely.
Commissioner Piercy,
Yes.
Chairman P.
Yes. The motion carries. Thank you, Mr. Brooks.
Thank you.
Item 15, General Fund Budget Amendment for the Fire Department. Chief Farley?
Mr. Chairman, I have a budget amendment tonight to move $63,200 of diesel fuel, communications, utilities, and fire permits, and move that money broken down into vehicle maintenance, pest control, site development, and instructional supplies and materials.
I have a motion and a second. I had a second over here. Piercy. Any further discussion? Hearing none, call roll, please.
Commissioner Sereno?
Yes.
Commissioner Gooch?
Yes.
Commissioner Harris?
Yes.
Commissioner Irvin?
Yes.
Commissioner Johnson?
Yes.
Commissioner Piercy?
Yes.
Chairman P?
Yes, motion carries.
Thank you.
Thank you. Next up is a general fund budget amendment for the Planning and Engineering Department.
Thank you, Mr. Chairman, and good evening, committee members. Doug DeMasi, Planning Director. Just moving a little bit of money around in our budget. We're not asking for any new money. You'll see that we're moving about $2,500 from in-service training into our legal notices and postal charges, line items. That's just to cover advertising costs and mail-outs. We've had a little bit more activity as far as the mail-outs go and for our legal notices that we have to run. You'll also see some money being moved from consultants, engineering services, and transportation equipment into motor vehicles. We did have a little bit of money left over in our motor vehicle line item. There is another vehicle that we have that needs to be replaced. Rather than ask for that in next year's budget, we have the money to move around in this particular budget we're in now. So we're asking for that money to just be moved into the motor vehicle line item. And I'll be happy to answer any questions.
I have a motion to approve. The second, Commissioner Johnson. Further discussion? Call roll.
Commissioner Sereno?
Yes.
Commissioner Gooch?
Yes.
Commissioner Harris?
Yes.
Commissioner Irvin?
Yes.
Commissioner Johnson?
Yes.
Commissioner Piercy?
Yes.
Chairman P?
Yes, motion carries.
Thank you very much.
Thank you. Next up, and the next three, I think, is the ambulance service fund budget amendment. First one is for donations. Welcome.
Good evening, Chairman, Commissioners. Brian Gaither, EMS Director. The first one is to recognize donations received in the 24-25 fiscal year and 25-26 fiscal year and place them into our other supplies and materials line item.
Michael, can we take any of these together?
Take them all three together if you'd like.
Okay, the committee says they'd like to. Please continue.
The next one is we're asking to move $50,000 from our patient charges line items into our refund line item. This is due to the increased amount of patient refunds and insurance refunds due to overpayments. And the last one is to recognize the $30,303.03 from the Tennessee Department of Health Essential Equipment Grant that we applied for and received, and to place that into our health equipment line item.
Second.
Have a motion and a second. Any further discussion? Call roll, please.
Commissioner Sereno?
Yes.
Commissioner Gooch?
Yes.
Commissioner Harris?
Yes.
Commissioner Irvin?
Yes.
Commissioner Johnson?
Yes.
Commissioner Piercy? Chairman P?
Yes, motion carries.
Thank you.
Thank you. Item 20, request for application acceptance for the Custody Prevention Services Grant. Welcome.
All right, this is the juvenile court's request to make application and accept a grant for our custody prevention services. This is a grant we've had in the past, I believe. It's just a pass-through grant, seeks nothing from the county. This is for our child support department.
It'll be for the 27 budget year, next budget year.
Correct.
A pass-through from,
Who's the grant? I think it's tied in with the Department of Children's Services.
It is.
It's 46,000 some odd dollars.
Yes. It's $46,448. It's a pass-through from the state. And then you can see the grantee budget on page 3 on your iPad.
thank you.
Okay, you've heard the request. I have a motion and a second. Any further discussion? Call roll.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris,
Yes.
Commissioner Irvin, Commissioner Johnson, Commissioner Piercy,
Yes.
Chairman P.
Yes, motion carries.
Thank you.
Thank you. Next is item 21, request for application and acceptance of the Teen Learning Center grant.
Hello, Todd Savage, Director of Youth Services. This is asking to apply and accept the Teen Learning Center grant. It's $417,696. This is pass-through money. We've had this grant for many years, and it requires no match from the county.
Have a motion
Second.
and a second. Commissioner Sereno. Any further discussion? Call roll, please.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris,
Yes.
Commissioner Irvin, Commissioner Johnson, Commissioner Piercy,
Yes.
Chairman P.
Yes, motion carries. Thank you, sir. Request for application and acceptance for the Second Chance Act addressing the needs of incarcerated parents and their minor children grant. Welcome.
Good evening. Good evening, Lindsay Davis, the Reentry Program Coordinator with the Recovery Courts. So we do have two requests tonight. The first one is that we are requesting permission to apply and have the mayor accept if awarded. It's the Second Chance Act addressing the needs of incarcerated parents and their minor children through the Office of Juvenile Justice and Delinquency Prevention. This will address the needs of incarcerated parents and their children. It's a collaborative effort between the Recovery Court, Reentry Program, the Adult Detention Center, the Correctional Work Center. The project is up to $750,000 for 3 years, and there is no match. I'll be happy to answer any questions. I can.
Can we do both of these at the same time?
Yes. They're both no match, so if you wish, yes.
Please continue then.
Okay. And then the second one that we have, again, another grant that we're asking permission to apply and have the mayor accept if awarded. The Project RISE grant, which is through the Opioid Abatement Council. This will address opioid treatment and recovery support for the incarcerated individuals. It's also a collaborative effort between the Recovery Court Reentry Program, the Adult Detention Center, and the Correctional Work Center. This project is up to $500,000 for 3 years, and there's also no match. I'll be happy to answer any questions.
I have a motion to approve
Second.
and a second. Discussion.
So that's Rutherford County can receive up to $1,250,000?
I'm sorry, can you repeat that?
In other words, that's the total number. We could get up to, I think it was 500 and 750 or something like that.
Correct, yes.
So Rutherford County can get up to $1,250,000.
Correct, two different grants, but yes.
Okay, and that's all for, we don't have to share that with anybody. There's no match.
No, we wouldn't be sharing with anyone. We just have the collaborating partners, the agencies that we would work together.
What she's saying is it's not for personnel. The Project RISE grant is not for personnel. That's a up to $500,000. So we would be hiring third parties to be a partner with us as part of the reentry program, but it's not hiring personnel. So that's what she meant by the collaborative partners. But there is no match, and it would be for Rutherford County. We choose who those collaborative partners would be as to partner with our reentry program.
Yes.
Is this like a recurring thing, or is this like one-time thing?
One-time thing. These are brand-new grants that both agencies just released for application.
Any further discussion? Call roll.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris, Commissioner Irvin, Commissioner Johnson, Commissioner Piercy,
Yes.
Chairman P.
Yes, motion carries.
Thank you. I'll have a good evening.
Hey, thank you. Next is a request to apply for the fiscal year 27 Stop Domestic Violence Court Grant. Welcome.
Good evening, everyone. Sari Castillo, Coordinator for Domestic Violence Court. So today in front of you is an application for the 2027 STOP grant. This application is not asking for any money. It's not changing money. What this is the grant that I'm under The Office of Criminal Justice Programs has a new procedure. A couple of things have changed procedurally with applying for grants and reports. So all this is submitting the application with permission to continue to have the funding we already have. And the main reason for this is just due to a new grants management system that the Office of Criminal Justice Programs has. But this is what the application is for. Again, it's no new funding by any means. It's just carrying on to what we already have. This was supposed to go in front of the Public Safety Board. I mistakenly missed that, so I did talk to Mr. Pettis-Reed about presenting it to this commission, so I'm in front of you today for this application.
Any questions?
Is there a match?
There is a match on here. This is a grant we've had for several years. They're doing a more formal process for this. It does fund part of Cerie's office. So there is a 25% match. It's on the first page on your iPad there. We have that in the budget every year. One of the things about this grant is if we didn't have it, we would have to fund the 100% because we have to have the domestic violence court. So there is a 25% match, and so we would ask that, like, if it's approved tonight, that we be able to go ahead and accept and award this, and then we'll build this. This will be for the FY27 budget year. It's not for this year. We already have the grant approved for this year. It'll be for the next budget year to fund a portion of that office.
Motion to approve.
I have a motion to approve.
Second.
And a second. Further discussion? Call roll.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris, Commissioner Irvin, Commissioner Johnson, Commissioner Piercy,
Yes.
Chairman P.
Yes. Motion carries.
Thank you all. Have a good evening.
Thank you. Next is Juvenile Detention Center Behavioral Health Treatment Services Provider Contract with Volunteer Behavior Health.
Good evening. In front of you, you have a updated, worded contract with the Volunteer Behavioral Healthcare Systems. The county attorney has approved it. It is the same it doesn't increase any of the charges for any of the services they provide. The only difference is that there was some added legalese to it. This is sort of a grown-up contract compared to what we used to have, and I will try to answer any questions you have regarding.
Any questions from the committee? And basically, this is just an updated contract
Yes, sir.
and no changes as far as expense goes. Michael?
Nope.
No, this will be built into Lynn's budget or juvenile detention budget every year. So, but every so often, we have to have a new contract with them, and then usually both sides of attorneys add something additional, and in that case, they added some more. I don't know what specifically. I don't have that in front of me, the red line version, but the county attorney did add a few things to it to update it to current standards.
Our attorney did?
Yes.
Okay.
Yeah, Nick did.
Okay, you've heard the request. Do I hear a motion?
Move to approve.
Have a motion and a second, Commissioner Johnson, to approve the request. Any further discussion? Call roll, please.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris, Commissioner Irvin, Commissioner Johnson, Commissioner Piercy, Chairman P.
Yes, motion carries. Thank you, Lynn.
Thank you.
Item 26, Solid Waste Fund Budget Amendment for Insurance.
So I would ask the committee if it's okay if we could take items 26 and 27 together. They're for the exact same thing, if that's okay with the committee.
Yes.
So every year, we take a cleanup amendment towards the end of the year for insurance. And And so I never know who's going to charge family, who's going to have single coverage, those types of things. And so this amendment cleans that up at this year, once we kind of, everybody's settled out after the new election and open enrollment changes. And so that's what this amendment does for both the solid waste fund and both for the general fund.
I have a motion to approve and a second. Further discussion. Call roll, please.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris,
Yes.
Commissioner Irvin, Commissioner Johnson, Commissioner Piercy,
Yes.
Chairman P.
Yes, motion carries. Item 28, Michael.
So this does not require a vote tonight, but it's our report on debt obligation. And if you noticed, a couple months ago, we talked about a refunding that we did. And so now that has all closed. We officially closed on that last week. And so we're required to present to this body, and I'll have to present it to the full body of the commission next week. So this is the summary of that closing of that refunding. And we have to do it for the minutes, but on that first page there, I'll point out one or two things. We refunded that debt from 2016, but everybody always asks what our true interest cost was, and you can see that right there in the middle of the page. It was 2.59, and that was for 10 years of refunding. We replaced previous 10-year bonds. And if you remember, we saved well over $1 million in the range of 1.2 to 1.4 million, depending on your present value calculation. But you can also see our AAA ratings right there. But again, no vote needed tonight. We're just required to present that. I'll take any questions if there are any.
Any questions, any discussion? If not, we're going to move on to our next business. Hearing none, we are now under other business. Item A is a interlocal agreement with the City of Murfreesboro for the Department of Justice 2025 Byrne Justice Assistant Grant, the JAG grant. This has not gone through public safety because we just got it. And this is a ongoing grant that we have had for several years. 1 year we implement it or handle the finances of it, and then the next year Murfreesboro City does, and it's a shared grant between Murfreesboro Police and our Sheriff's Department. But Michael, you want to add anything to that?
So this grant was actually approved in May of 2025, and we attached that resolution there just for your reference. What really we need to run back through was the actual interlocal agreement that you'll see attached there. We just got that back from both sides. As you know, the city is in process of changing attorneys, and so we just got that back. I do believe that the Sheriff's Office reached out to Chairman Reed of Public Safety, but that's why it's before you tonight, so that we can get this before the deadline. I don't know exactly the deadline. I believe it was next week after commission sometime, but that's what you see before you tonight is we're actually approving the interlocal agreement. That's the second attachment there. And again, this was originally approved in May of last year, the grant, and I attached that resolution for you just for reference. But the county attorney has reviewed this, and it has been approved also by the city. And as you can see, the interim city attorney has signed it on the last page.
Any further discussion? Not, we'll entertain a motion to sign off on this agreement.
So move.
I have a motion, Commissioner Sereno. A second, Commissioner Johnson. Further discussion? All in favor signify by saying aye. Aye. Any opposed? Motion carries. The last item on the agenda is item C, the ROB Committee approvals for the fiscal year 26-27 budget. First, there's a contract with MTSU, and then a probation department position that we discussed with possible funding through the ROB Committee. Michael, you want?
So I'll touch on this. Tonight, really, the vote is to give me direction to go ahead and put these as part of next year's budget. We do not have to settle on funding tonight. That can all be changed, is subject to change. For example, if you want to pull something out of ROB or put it back in. But this gives me direction to go ahead and put these two items as part of the budget for next year, for 2027. And then if you remember, when we go through the budget process in May, there'll be one of the nights as we have all the departments come in, we'll actually talk about the Rob committee approvals in detail that night. But this goes ahead and gives me direction to put the MTSU contract and the probation department position in the budget for next year. This will stop tonight at budget. If this is approved, it will not go to commission. This just gives me direction to put that in, and then it'll go to commission as part of the 26-27 budget.
Any further discussion?
So moved.
I have a motion
Second.
and a second. The monies that we're talking about for NTSU contract and this probation department position would be coming from the ROB funds as far as working that in your budget. Is that correct, Michael?
Sorry, can you repeat that?
I said the actual funds for the MTSU contract and the potential department position would be coming out of the ROB funds.
Yes, and then obviously if there was something y'all wanted to change as part of the budget process in May, you can definitely do that, but I'll build it in initially there, and then we can, this body can change that in May if they wish, but yes, initially we got it.
My point was this wouldn't affect tax rate one way or the other.
Oh, no, not at all.
All right. Any further discussion? Call roll, please.
Commissioner Sereno,
Yes.
Commissioner Gooch,
Yes.
Commissioner Harris,
Yes.
Commissioner Irvin, Commissioner Johnson, Commissioner Piercy, Chairman P.
Yes, motion carries. Gentlemen, that concludes our business tonight unless somebody else has a comment they want to make. If not, I want to thank you for your hard service. We're adjourned.